Hello, I'm David Cassidy, Chief Investment Officer for Canaccord Genuity Australia. Our investment outlook for the 2027 financial year is still quite positive. We think that in particular global equities are still very well positioned. From our perspective, the earnings cycle is still very supportive for global equities, seeing very strong earnings growth in both the US and Asia, driven by the boom in AI capital spending, but we think that's likely to be sustainable over the next 12 months at a minimum. So from that perspective, still quite positive towards global equities. Still think that areas like alternatives, selective opportunities, but that global equity position is really the core of our positive view for the next 12 months at least. In terms of the key risks we're following for the next 12 months, we think there are two. Firstly, the global inflation cycle is still something we're watching quite closely. Inflation is elevated. It's not really where central banks would like it to be at this point. So from that perspective, we think there is a risk around inflation staying sticky and central banks having to retighten over the next 6 to 12 months. Obviously, the situation in the Middle East is still quite fluid. And from that perspective, the oil price is also a key risk feeding into that potential inflation problem. As a base case, we think inflation has probably peaked at a headline basis and probably on a core basis. We do think it'll come down, particularly in the US, over the next 3 to 6 months, such as the Fed can remain on hold and probably cut around about the middle of 2027. So from our perspective, we are watching inflation quite closely. We do think inflation pressures will ease over the next 3 to 6 months. Second, in terms of key risks, the AI capital spending has obviously been a huge tailwind for the global equity market over the last 12 months. Huge uplift in profitability coming through in the US and Asian tech sector, but still lots of uncertainty about how the whole AI story plays out over coming years. So from that perspective, we're watching for signals around the durability of this capital spending and obviously the flow through in terms of broader enterprise adoption. So in the near term, US reporting season is going to be very closely watched in terms of the clues around capital spending, return on invested capital, broader enterprise adoption. So AI, both a tailwind and a potential risk, but certainly is something we're monitoring very, very closely over the coming year. Yeah, in terms of our outlook for Australian equities, they were quite disappointing in respect of the last 12 months. We got a total return from Australian equities of around about 6%, so well behind what we saw from global equities over the last 12 months. I think there's a couple of reasons for that. Firstly, the inflation situation in respect of the domestic economy is probably even stickier and more stubborn than what we're seeing in the US and globally. So therefore we think there is a risk the RBA will possibly have to tighten again in the near term. We certainly see potential for a cut as being quite some time off, probably more than 12 months at a minimum. So from that perspective, if the RBA has got its foot on the brake, we think that is an issue for the domestic economy and the domestic profit cycle. And I think the other reason Australia's been a laggard and is likely to continue to lag over the next year is just market composition. We don't have the tech exposure that the US or Asia have. We have a very big banking system. If anything, we think conditions for the banking sector is going to get tougher, not easier. So from that perspective, even though we're still quite positive on mining, and we think significant portions of the non-industrials can have a better year on a 12-month view, we still think the Australian market is going to be constrained, particularly by that lack of tech and that big banking sector exposure. So from that perspective, still think it'll be a positive year for Australian equities as it was in FY26, but we think it'll be a case of single-digit returns in terms of our base case. In terms of our strategy in respect of alternative assets, what role do they play in diversified portfolios? We see alternatives as both a diversifier and a return enhancer. And I think with the inflation situation looking uncertain, I think we need to go beyond just fixed interest as a diversifier in terms of portfolio construction. So from that perspective, we're looking at both growth alternatives and defensive alternatives. We think there are still good opportunities selectively in areas like domestic and global private equity, domestic private credit, we're still quite attracted to. Once again, selective in terms of managers, but still think the outlook is quite good. And real assets, infrastructure, selected commercial property, we still see good opportunities in that part of the investment spectrum. And even in commodities, we think The gold trade is, we don't think it's over. It's had a bit of a pullback, but if the Fed is going to remain on hold and possibly cutting somewhere in the next 12 months, we think that's supportive for gold. And on a multi-year view, we still see central bank accumulation as a key positive for the physical gold price on a multi-year view. So still think alternatives are an important part of the investor toolkit. We're moderately overweight in alternatives in terms of our current positioning. In terms of our view for the next 12 months, still constructive on risk assets, overweight global equities, moderately overweight alternative assets, more neutral on fixed interest, with inflation still something of a concern, and still think Australian equities produce a positive return over the next 12 months, but are going to lag global equities, so moderately underweight Australian equities. So broadly constructive, but obviously some preferences there in terms of our asset class positioning.